Continuing on the theme from last month, housing activity continues to slow as expected when the Bank of Canada raised interest rates by 100 basis points last month and instantly reduced borrowers' purchasing power. Remember, over 50% of new mortgage applicants this year have been going with variable rate mortgages, in large part to dodge the pain of a higher mortgage stress test that accompanies fixed rate mortgages. The pain's not over yet, as we should see another hike from the Bank of Canada on September 7th. While rising interest rates are needed to squash inflation, the housing market, that's become the casualty here. Buyers have shifted to the sidelines, and that is evident when looking at the latest housing data. Greater Vancouver home sales fell to a 22-year low in the month of July. There were just over 1,900 sales this July, a low not seen since we recorded 1,651 sales in July of 2000. Keep in mind, this is not even adjusting for the increase in population and housing stock, which has increased rather significantly over the past couple of decades. Demand, it's weak, and it's not hard to figure out why. A doubling of mortgage rates has eroded affordability. Just for context, to understand where we are right now, house prices would need to drop in about 25% to be as affordable as they were at the peak of the market earlier this year. Let's assume an 80% loan-to-value ratio, a 30-year amortization on $1 million house. Mortgage rates double, but price declines 25%. So you have $800,000 mortgage at 2.5% equals $3,156. A $600,000 mortgage at 5% equals just over $3,200. So now there are two questions to consider. One, how long will it take sellers to reduce prices? Home sellers are notoriously slow to cut prices, and total inventory for sale remains historically low still. And two, will mortgage rates hold at these levels? The number of new listings for sale in July was actually down from last year. Meanwhile, the total inventory for sale was also down from last year. In other words, there are fewer homes for sale today than there were a year ago. So despite inventory being lower, the total months of supply on the market has actually pushed higher, and that's solely due to incredibly weak demand. If this bear market is going to continue, we're going to need more inventory. And I suspect more inventory is coming, but it's something we need to watch closely. Meanwhile, the Canada 5-year bond yield is down nearly 100 basis points since peaking just over a month ago. The bond market, it's telling us that a recession is right around the corner, and this should be driving fixed rate mortgages lower. However, we've yet to see any of the major banks cut their rates yet. They're pricing in a risk premium, at least for now anyway. But it's not unreasonable to expect fixed mortgages to begin moving lower very soon. We could soon be in a situation where variable rate mortgages are higher than fixed rate mortgages. Mortgage rates remain too high for a highly levered housing market, and that will keep weighing on the housing market in the months ahead. Home prices, they are adjusting, with the home price index now down 4.5% from the peak. This is understating the decline in prices. As we've talked about before, the home price index is a lagging indicator, and it does not capture the rapid changes in market conditions. The median sales price does a better job, but it's still not perfect. The median price suggests that the market prices are down 10% from the peak, but still up nearly 5% from last year. Here's basically what you need to know. Home buyers are incredibly tepid right now. Everybody wants a deal, and most want to keep waiting for a better entry point. Sentiment is pretty terrible. However, inventory remains pretty sparse in most areas, so there isn't an abundance of selection. Buyers will have better selection once the fall market kicks off in September. We're seeing a ton of accepted offers collapse on financing. Buyers are tying up properties with the subject to sale only to figure out that mortgage rates, they're punitively high, or they no longer qualify for the loan amount that they were offered several months ago. Buyers are making offers subject to the sale of their existing home as well lately, and that's becoming a lot more common to see in the market. Ultimately, the path forward for the housing market, it looks choppy at best. We should get more clarity once we enter the normally busier fall market. Busy fall, busy spring. This is usually what we see, seasonality. But let me tell you, long gone are the days of underpricing a house with the expectation of receiving 10 offers and driving the price to record highs. Buyers are tepid and they're no longer interested in competing for homes. This is best highlighted by looking at the number of homes sold above the asking price. In July, just 16% of single-family homes sold above their asking price. That's down from a record high of 63% in February of this year. Now, I know what you're thinking. Isn't 16% still high considering that sales are touching multi-decade lows? Well, this metric, it's not perfect, but it is a good barometer to highlight speculative excesses. The homes you see selling over the asking price today are much different than back in early 2022. A house worth 1.6 might get listed at 1.3, get 5 offers, all with subject conditions, and then sell for 1.5 million. In this case, buyers aren't bidding up houses. In fact, they're underbidding them, and sellers are arguably worse off. It makes more sense for a seller to list at 1.7 and wait for your one buyer and give yourself $100,000 worth of negotiating room. However, some sellers don't have the luxury of waiting a month to sell their home, and they want it moved ASAP. It's for this reason they price low for multiple offers and properties are still sold over asking price. So as we've talked about over the past several months, things look even more dramatic in the Fraser Valley. The number of single-family homes sold above the asking price hit a cycle high of 80% in February and have since fallen to just 12%. In summary, if you're looking for a quick sale, you can still price low and get multiple offers. Just don't expect a good price. Buyers are in the driver's seat and they're looking for deals. Now let's move on and talk about the team at the Royal Bank. The RBC economics team made headlines this past week calling for a historic correction in the nation's housing market. I typically don't put much weight on forecasts as they really should be called guesses. However, it's an important sentiment check. Our largest bank has called for a 23% decline in house sales this year and a 12% in the nationwide house price index from peak to trough by the second quarter of 2023. Again, this is highly unusual for a major bank to make comments like this. Just for context, RBC's forecast would rank as the steepest correction of the past 5 national downturns. While 12% might sound low, remember this is measured using the national home price index, not average house prices in Toronto's suburbs, which have already blown through 12%. During the financial crisis of 2008-2009, national home prices declined by 9%. So far, we're down 6.7% from the peak. So if RBC's guess is correct, we're about halfway through this correcting. Again, all very hypothetical, but it's kind of fun to speculate. Remember, the US house prices crashed 19% on a national level from peak in 2007 before ultimately bottoming in 2012. It was much worse in certain areas. Keep all this in mind when you see numbers forecasted left, right, and center. At the end of the day, nobody knows what's going to happen, but here are a few things that I feel quite confident about. 1, mortgage rates are still too high and are hurting demand. 2, there's more pain to come for variable mortgage holders. 3, central banks are always 2 steps behind. So sock away some extra cash and enjoy your summer. We'll have more clarity in the fall. While interest rates surged higher, Canadians are still being paid to borrow. Real interest rates are deeply negative, coinciding with our belief of a prolonged era of financial repression. In essence, there's too much debt, and it'll be extremely difficult to run positive real interest rates for a sustained period of time. Even with mortgage rates at 5% and inflation at 8%, you're being paid to borrow. So let's see how far the Bank of Canada can push rates up. The bond market seems to think the Bank of Canada is making a policy error, with the spread between 2 and 10-year government bond now negative 50 basis points. This is the deepest yield curve inversion in recent history. So what this is basically saying is that the Bank of Canada is raising interest rates so much that they're going to choke the economy and kill the economic growth. The 5-year bond yield is also telling us this, and it's down nearly 100 basis points since peaking in June. So despite this, the big banks have refused to cut mortgage rates, preferring to bake in a risk premium given the negative outlook, not just for the housing market, but for the economy in general. Banks are getting much more conservative on the lending side, which is another reason why we're seeing a lot of deals fall apart on financing. One big bank tells me mortgage applications were down over 50% last month. So that's what we've got for this month. I hope you found it helpful. My name is Josh Kepke, realtor with McDonald Realty. If you have more questions about the market and what's going to happen and what I'm seeing on the ground, you can reach me at 604-313-9805. I'd love to take your call or text, or you can email me, sold@joshkepke.ca. Have a great rest of your summer, and we'll see you in the fall.